Good evening, everyone, and on behalf of the Edelweiss Mutual Fund team, welcome to another edition of Connect. It's at least been some time for me since I got to connect with all of you all, and very, very excited about today's conversation. Now, by the number of registrations that we've got for today's session, I suspect our guest doesn't need an introduction, but I'll still have the fun of doing the introduction. So would love to welcome Vishal Khandelwal, who is founder at safalnivesh.com. Of course, he's a well-known investing face, but Vishal is a firm believer in the power of long-term compounding. Almost 20 years of market experience as an investor and investment coach. He helps people learn the art of intelligent investing and behavioral finance. He is the author of this wonderful book called The Sketchbook of Wisdom, a copy of which I have, and the creator of an equally wonderful show called The 1% Show. One thing, Vishal, I haven't told you is that you've, of course, interviewed me on The 1% Show. And I've done so many interviews, so many people have interviewed me over the years. And my mother ends up seeing all those conversations. But she really believes my best conversation and best interview till date is with you. So there's some magic there.
Thank you so much, and so glad to know that.
Great. So, Vishal, I think before we dive into investing, I think in some way this conversation is also about understanding our life. This is also an age of entrepreneurship in India, and you have a very interesting journey. You started from being a employee, then you did your own blog, then you helped investors write books. And I remember you had a tweet that you remember the day that India won the Cricket World Cup. Not only because we won the Cricket World Cup, but that's the day sort of it all happened. So, what was the motives? What was sort of the journey here? What kind of inspired you to take that risk? And I guess, 11 years since India won the World Cup and you started, how do you look back on it?
Thank you, Radhika, first for the introduction and for having me on this show. It's a pleasure. My journey started in the stock market in 2003, and for the last 19 plus year, I think it's largely a matter of serendipity and a lot of good luck, which has really helped me across various phases, right? So I'll give you examples of serendipity and like how it has helped me at various phases, right from the very start of my career. So I started in 2003, right out of my MBA, and that was the first and last time my employer, who was an equity research company, came to a campus, right? And there were no jobs. I wanted to get into foreign exchange market, but there were no jobs. So by accident, I got into foreign exchange market or in the equity research market because I promised my to-be wife that I would get the first job on hand so that she does not get married somewhere else. So by luck, right, I got into stock markets and things really happened. I started liking the work. The second moment of serendipity or luck is that I got into an independent research company and not a broking company, which even now I think would have been against my very personal nature in terms of fast-paced world, a world of trading and commissions and buy-ins and all those kind of things. So I started with an independent research company with a focus on long-term. So that focus on long-term and the idea that long-term investing really works got ingrained over there. So that was another moment of luck for me. Because I was working in that organization, because we focus on long term, I came to know more about Warren Buffett and Charlie Munger, who actually have a huge amount of impact on my life as an investor, as a human being as well. So if not for the kind of work that I was doing then, probably I would have not been reading Munger and Buffett and learned so much from them about various things that I've written about on my blog for so many years. The fourth thing happened is I left my job in 2011, and that was because I wanted to get on ground and teach people how not to lose their money in the stock market. The first 5 years of my career as an analyst were the best bull market India's ever seen. Yeah. 2003, 2008, the Sensex moved around 7 times. And as an analyst, when you have 5 great years and at the very start of your career, you think you are a master of the universe. You start thinking that it's your skill that is causing people to make money on your recommendations. And this is when I realized in 2008 that it was largely a matter of luck that we were in a bull market and not really my skill. So, and the reality was shocking, right? 2008, you were in the financial space and you know that better. So that was when the realization set in that I should be doing something better with my life instead of writing stock reports. So I thought of getting on ground using my love for writing and combining that with some kind of financial literacy. I had no idea what exactly I wanted to do, but this is something which I had in mind. And when I left my job in April 2011, when India won the World Cup, so that was my last day at my job. 2 months later, my son was born, 2 months premature. And he was like hospitalized for almost 20 days. And that took away almost 50% of my savings. Right. So, but the thought was to not go back on the job because I never started with a plan B. I had a plan A only, and I wanted to focus on that. So in hindsight, it may seem very adventurous. Okay, courageous that you don't have a plan B and things all work out well. But I realized thinking back that it was a tough period, really tough period. And I would like to offer credit where it is due, Edelweiss, in the sense the person who hired me in 2003, my ex-boss, in 2011 was working at a senior role at Edelweiss in the broking side. And he knew that I sort of wrote decently well. And he hired me to write as a freelancer on a retainer basis to write for Edelweiss in terms of the personal finance articles and a few articles on investing and everything. That gave me a lot of time to think hard on Safal Nivesh. If not for that stint as a freelancer with Edelweiss, I'm not really sure whether what I'm doing today would have happened, because I may probably have gone back to my job. So thanks to Edelweiss for that playing critical role. And of course, the biggest moment of luck for me happened in 2003 when I got married to this person, Vidhi, who's actually been a very solid support for me, right? So the journey has been through its ups and downs. We as a family have taken it together, have passed through it. And in hindsight, I think I have a lot of gratitude for luck and Providence for really showing the way across. So not my skill. I think it's matter of luck, which has really helped across the journey.
Your journey reminds me so much of markets. There are ups and downs. There is an element of luck. There's an element of serendipity. There's an element of patience and just sticking it through. But in the end, as I always say, the markets in the long term, the outcome is one that makes you very grateful about how far you've come. I also, and I will ask you a little later about this, Vishal, but it's very interesting. You got into the business of creating content and writing well before this era. I mean, well before this era of influencers, content creation, content becoming a business. So I think in that sense, I feel you were very, very ahead of the curve. So I'll ask you about that later. But, your blog and everything you say goes by this tag Safal Nivesh, and that's always fascinated me. And I always liked it because finally I do believe Nivesh Safal bahut hai. I mean, it is a very Safal thing. So how could you define Safal Nivesh?
So Safal Nivesh basically is a Hindi term for successful investor. Right now, if you were to ask me about investing as a definition of what really investing means, right? So I think the general definition of investing is that you lay out some money now with the expectation of receiving more money in the future. But I think that real definition, and as I've learned over a period of time, as I've evolved as an investor as well, I think that definition for me has gone a bit deeper, right? Of course, it's a process of postponing consumption. It's a process of postponing consumption to the future and letting your money grow in a way that it takes care of you when you are not earning any more money, right? When you're retired, for example, and the salary and the income stops coming in. So that's where investing helps you. But for me, I think the real definition of investing is that it's a tool that has helped me achieve certain things in life, right? It's largely a tool, nothing more than that, right? And for me personally, it has served a dual purpose. One is that investing sensibly for the past 19 years, and again, I'm thankful that I have been sensible for the last 19 years. It has helped me achieve some kind of financial independence so that I don't worry about money anymore. And that's the reason the kind of work that I do, I think that also that is also where financial independence really helps. That you love. Or that the kind of work that you do is the kind of work that you actually love doing, right? So investing for me is a way to achieve financial freedom. And because of financial freedom, I would use a term which I think famous author Kurt Vonnegut said. He said that you should be doing something in life, maybe art or maybe painting, maybe music or maybe writing essays and everything that helps your soul grow. right? So as a way of achieving financial freedom, I have been able to pursue things like blogging, writing. 95% of my work or more than that on my website is all free. And I've been doing this like that for the last 11 years on straight, without even thinking of monetizing the entire thing, without getting into stock recommendation or money management, because that is not what's going to help me grow my soul, right? Writing, teaching people, illustrating now, writing a book that really helps me as a human being, helps my kids if they want to read that kind of a book, right? That is what helps me grow my soul. And I think for everyone, investing should have a different definition apart from the base definition of postponing consumption, growing your money to help you in your retirement years. So probably I look at everything that I do, especially investing, as a way that it helps me do a job, right? Education helps you do a job. School helps you do a job in terms of education, learning. Investing also should be looked at a way of helping you do a job. Some people find entertainment in it. Some people want to make a living through trading in it. Some people are looking purely from financial independence. I look at it from a financial independence point of view. Plus, it helps me grow my soul because it allows me to do so many things in life that I love doing.
I love that point you make, Vishal, because one of the things I also keep telling people is that investing isn't some kind, for most people, it's not some kind of horse race. It's really not a competition of uska fund quartile one, mera fund quartile two, ye benchmark. I mean, most of us don't wake up and say the benchmark has done this and I have done this, and this is it isn't like that. We want to live, as you said, rich lives. We want to do things that sort of soulful. I think we want to live that kind of life, and investing is finally about purpose and living a better life. So I think that it's nice that comes from you. I want to deep dive into value investing. Of course, you've been a student of value investing. You studied some of the greats. As we said at this point in India today, when there is so much conversation, one about momentum, about valuations, about unicorns, when many good businesses also, forget all of that, trade at high valuations. Do you think there is a case for value investing in India? I mean, what is the Indian case for value investing?
So I have been a value investor, and I have my biases in favor of value investing for sure. But I think before getting into the definition of what value investing is, I think we must first clarify what value investing is not. Right. So the definition of value investing or value investing as a profession or a subject, I think the groundwork was laid by Ben Graham in the 1930s, who's called the father of value investing. And that time he was talking about something called as statistically cheap bargains, which means mathematically stocks which are cheap. They are supposed to be those stocks which you use by, right, as value stocks, buying something worth 100 rupees for like 50 rupees, 60 rupees. I think with the evolution of investing, value investing has also gone has gone through an evolution. Now it's not about, or probably it's not only about buying cheap stocks or statistically cheap stocks when you get them, which is very rare in today's world. We are in a world where brand plays a role. We are in a world where information is available to everyone at a click of a button. So there's no information scarcity. In those times, people who had information were able to buy stocks cheap, knowing that the stock is really cheap compared to the asset values. In today's world, I think value investing has evolved into a field where it's about buying high quality business. This is where I come from. People may have different definitions. But for me, I think value investing means finding value in a high quality business's future growth. Right. So there, I also want to lay this confusion away or drive this confusion away, where people differentiate between value and growth. There's no difference between them. You find value only in something that is going to grow. If something is not going to grow, if a business is not going to grow, there's no value. You are, of course, buying a dud stock just because it's cheap, right? Yeah. And a lot of people look at low PE stocks. A lot of people look at 52-week low stocks or stocks. And very interestingly, I've received a lot of questions about people asking what are the kind of 2-digit or single-digit stocks which are part of value investing, right? Or where they can find value. Stock prices don't make a stock cheap, right? It's the price versus reality. So a stock price at 1,000, 10,000 rupees can be much cheaper than a stock price at 10 rupees or 1 rupee as well, right? So thinking about value investing as a way of finding value in high-quality businesses and their growth over a long period of time, I think that is what value investing means to me. It's not anymore about cheap stocks, because cheap stocks are there for a reason in today's world. right? Low P stocks are dangerous, penny stocks are dangerous, and people need to understand that. Of course, I'm not also in the camp that believes that if you find a high quality stock, you can pay up anything, right? So buy at any price is not what I'm suggesting here, but you have to pay up for quality, but not overpay. And that is where the hard work comes in. That is where, as they say, value lies in the eyes of the beholder, right? So you have to be that, you have to possess those eyes which can find real value and separate it from something which is fake. So I think that is, in essence, what value investing means to.
So you're saying the definition of value has evolved in an environment where information is not the edge, which is why I always find it funny when people come and say, give me a tip. I mean, there's no information I know, that will enable you to do well. It is essentially paying for growth. And perhaps India is also a growth market in many senses, right?
It is. India, we recently saw ranked fourth in terms of the size of economies. India is going to grow for the enterprising people that we have and the growth curve that lies ahead, right? So a lot of people say that India has a lot of legs to grow and the Indian markets have a lot of legs to grow in the future. When I hear such kind of things, my question to people is, do you have the leg, or do you have the legs to carry on with India's growth for 20 years? You may be boarding the train now. You may want to go to Delhi from Bombay using Rajdhani Express. But what if you get down at Surat and you want to catch another train which is coming faster? You should not be doing that. You have to find a process. You have to find your own path and just move on to that if you really want to benefit from India's growth story. You cannot be buy and sell all the time.
I want to pick up that point that you mentioned about the train and sort of how do you sit on the Rajdhani from Mumbai to Delhi? Behavioral finance, being long term, I mean, not making all the behavioral, it's something that's talked about a lot. What I want to ask you is, how do you practice that? How do you have it in you to sit on the Rajdhani when, the train gets bumpy, when someone, especially in today's information age, where, Vishal, when you are on social media, everyone's talking about how well each other's portfolios are doing. The temptations are so many, information is so many. How do you sit on the Rajdhani?
I think it's difficult when you are hearing a lot of noises. It's difficult when you're on social media and when you're seeing other people getting richer faster. And I think that's why Charlie Munger says that envy is the worst sin, because that is the only sin where you are feeling the pain when you are indulging in it, right? So if you know that this is the best train for you, for example, right, and this may go a bit slower than the other one, but this is where you find comfort, and you've been using this train for many years now, and this is you just enjoy the service of this train, right? You'll be boarding that train and keeping at it, right? So that is, as you rightly mentioned, I think that's also largely a matter of behavior, largely a matter of cutting off the noise from your life and news from your life, right? So good investing, I assume, is maybe 95% or even 99% good behavior and only 1% intelligence. Now, intelligence can be gathered or like gained in 5 months, 6 months, right? You can find out the financial statements as far as investing is concerned, or which stock is better, which mutual fund is better. You can hire an investment advisor to do that, or you can get a tip, as people get tips, right? But who gives you the conviction, right? How do you learn to behave well that when the thesis changes or when the markets fall, you still hold to, or you still remain seated in the train, even if it's going at like 10 kilometers for an hour for a train which was supposed to go at say 150 kilometers an hour. And you'll find those phases, right? You'll not jump off the train, right? So it's a vast subject, behavioral finance. And I understand that once you grow out of your teens, it's very difficult to change behavior, right? So the only thing that I work hard upon when I write about behavior, when I talk about behavior, when I teach youngsters about behavior and mental models and thinking, is that I should help them, or they should learn to minimize the mistakes of bad behavior. Our brains are not wired to make rational decisions. Munger says we are rationalizing beings. And Daniel Kahneman, for example, who's written this wonderful book called Thinking Fast and Slow, he's talked about 2 systems of thinking. System 1 is like reflexive. Like you reflex action, right? You see a stock price rising and you think it's an amazing stock. Reflective means you are pausing, you are reflecting, you are studying, you are analyzing, right? That's part of your subconscious mind. So it takes time. It takes a lot of pain and effort to improve your behavior. Reading some greats like Charlie Munger, Daniel Kahneman, Robert Cialdini, James Clear, Morgan Housel, Fernam Street blog, and all those kind of stuff are great resources where you can learn what not to do as far as behavior is concerned. So I think it takes a lifetime.
Vishal, you talk to so many investors, on this topic of mistakes. And in the Indian context, I mean, this doesn't have to be a long conversation on mistakes. What are the 1 or 2 that you might want to point out with maybe ideas on how to correct them in today's context?
I think as far as mistake is concerned, the most prominent which I see people, and I have made that as well, and they're very easy to find out mistakes, right? And others.
And all of us make it, by the way.
Yeah, all of us do that.
You're not perfect.
That's right. That's right. So I think two or three biggest mistakes that most people make as investors. One is impatience, that we want to reach somewhere fast, right? And that leads to, for example, in investing, that leads to people trading in a lot, people having short-term holding periods. The second big mistake is where, as I mentioned, people envy others making money fast, and social media has a lot to take the blame to take. And of course, people, how they behave in social media, I think it's crazy out there. The third is that a lot of people invest or make investment decisions with the idea of avoiding future regrets, which means if you own a bad stock, they'll keep holding it so that they don't turn their paper losses into real losses. And if they hold high quality stocks and they made some return, they'll sell it immediately thinking that their paper profits are going to go for a toss. So as I mentioned, I think most mistakes, like most of investing, is behavior. So most mistakes are also behavioral. Cutting noise, cutting social media, reducing as much of it as you can, right? As Buffett says, living with an inner scorecard. I think that really helps. Of course, we are not wired to make sensible decisions. So we have to believe in luck as well, being at the right place at the right time for a long period of time. One tool or two tools which have really helped me in terms of minimizing mistakes of behavior is having a sound process and having checklists. So checklists have been talking about in aviation, in medicine, but I think checklist and having a process automates a lot of your thinking. So you are not relying on your system one and system too much, right? You're relying on a fixed checklist. And it's not about going through a written checklist every point, every now and then, because then you are going to get analysis paralysis. You're not going to make a decision. But over a period of time, after you keep going through a process, after you keep going through a checklist, that hardware in your brain becomes a software, or that becomes a part of your brain, intuitive thinking, right? So checklist and process are two tools which are used to minimize investment behavior mistakes. And I think that is what people should be, I think, focusing on.
Vishal, speaking of mistakes, and by the way, I will tell you, I'm very active on social media, and you pointed it out. Often my fund managers, when they join, ask me that, when you joined the fund management business, do we have to be on social media? And I tell them exactly this. I say, no, don't be on social media. So fund managers, people who manage money, I think it's actually good because there is so much noise in fund management, especially in the mutual fund context, where NAVs are public, analysis. I mean, there is almost kung fu that happens on mutual fund data every single day out there. So fund managers should not be on social media. But, related to social media, I wanted to ask you, you've seen advice, you've seen the advisory business, you've seen the content business. There is, for an ordinary investor today, there is so much advice out there. There are professional advisors. There is advice that shows up on social media for free. There is influencer advice. How do you form a sensible relationship with advice? What is the content you read? What is the content that you don't read? What is the role an advisor can play in your life? And how do you find and create a sensible relationship with an advisor? Because I just think there's a lot of information, and now there's enough for investors to get deeply, deeply confused.
That's what I think. I would equate advice and news or like information with respect to investing otherwise with I think junk food, or food that is available all the time 24/7 for us, right? So rather than trying to pick up the kind of advice that you want to pick up or kind of information that you want to pick up, I would rather focus on avoiding things which are not really, or which are detrimental to my long-term well-being as far as my finances are concerned. And information comes with shelf lives. Some are like long shelf lives information, and some are like mostly news, and mostly the kind of stuff that we appear on television and social media, right? Are those information which have a very short shelf life, right? So even when I go on social media, right, I would rather want to read, and that's the reason I spend a lot of less time, like it's a lot less time on social media, following only those kind of people who largely talk about long shelf life information and information that may not really make sense in today's world in terms of moving stock prices and thinking about like conference calls and quarterly results and all those kind of things. I would rather read about ideas, right, which may not have a direct impact today, but which may have or may not have impact in the future, in long-term future. So if you cut out and that kind of information which has a short shelf life, if you reduce reading stuff which is ephemeral, and focus on some things which are enduring, right? So I have this illustration on things which investors should read, starting from ephemeral to enduring on a line chart. Ephemeral is mostly news, right? Enduring are mostly super texts, the texts that have been written like hundreds and thousands of years back, or even 50, 60 years back, right? Biographies, business biographies, books from Buffett, Munger, as far as investing is concerned. In Indian context, we have the Bhagavad Gita. There's so many good books written, right? Dale Carnegie, for example, Robert Cialdini, for example. If we focus on reading what is enduring and avoid what is ephemeral, which is largely news, I think we are setting ourselves for good times as thinkers are concerned. Now, when I say I don't read newspapers, people say, okay, but Warren Buffett reads newspapers and he says that you should read newspapers. If you're reading newspapers, you have to have that eye and the mind of separating signal from noise, right? How do you separate that, right? So I'm sure there's a very tiny amount of signal which is there in newspapers. There's mostly noise and paid noise, right? So as a retail investor, I am not able to separate that. So what I do, I would completely avoid newspapers. If there's a news, if there's information which is so important for my investment, it will come to me in today's world. It's not going to go away. So rather than actively reading newspapers and worrying about the world, that the world is going to end, right? Every now and then, I would rather let important and enduring information stay with me, because the capacity of the mind is too less. And if I may just add one more point, right? That comes from Sherlock Holmes, right? We know as the best detective in the world. He says that our minds, our brains are like attics, right? And they are already stocked with furniture. Right? And they have limited space. Now you can expand it over a period of time, but at a given point of time, they have limited space. If you bring in more furniture into that attic, you have to move out some existing furniture, which means the more you get information and noise into your brain, the good things, the knowledgeable things, the wise things that are in your brain are going to move out because there's no space. Yeah. Right? So try and ensure that you get only less amount of things, only those information and ideas which are long shelf life kind of things. And I think that should make your work easier, much easier. So know what to avoid.
I love the spectrum. I think ephemeral to enduring, and I think push yourself more towards the enduring side of the business. Now, I also want to sort of talk about, DIY. There's a set of people, who talk about doing direct stock investing. Of course, I'm biased, but there's so many solutions that come through mutual funds. Who do you think is a direct stock investor, and who do you think should be a mutual fund investor? And this is a tricky question, and I come from a very biased position, so I'm going to ask an unbiased guy this question.
No, I think I have that bias as well, because I have been a mutual fund investor ever since I started investing. Right? I invest almost like 10% of my money through mutual funds, my family money, some of my own money as well. And I think to almost 100% of people, my friends, family, relatives, or especially who come for me or who trust me with my advice, right? I ask them to go with mutual funds and not with stocks, right? A lot of people in today's world, when everyone is, as I mentioned, making money fast through stock picking, DIY, and every information is available, people think that not owning stocks is a shame. Right. Yes. So people don't want to own just mutual funds because they want to sound smart. Oh, I own this portfolio and this kind of stock, and this stock has done really well for me, because mutual funds don't rise or fall so much like stocks, right? You cannot make exciting stories out of mutual funds like you can make out of stocks. Right. So I advise people, if they are willing, if they have the knowledge, or they can build up the knowledge, or if they have the inclination to study businesses and own stocks for the long term, they should definitely pick stocks, but only after learning about them. But for people starting out, even when they're starting out, without losing the time of compounding, right? And you start out as soon as you say, probably get your first saving. I think people should start with mutual funds and stick with high quality, well-selected mutual funds for as long as they can. It's the same theory, like you select stocks carefully, you should be selecting mutual funds carefully. Like you should be owning stocks for a long period of time till the stocks or businesses remain good. You should be owning mutual funds for a long period of time. I have data, I think that's some more data, right? About one fund, which was my first ever fund when I bought in 2003. That was HDFC Prudence Fund, a balanced fund, right? And a few years back, I realized after the fund completed 20 years, I think just 2.5% of the people who owned the fund 20 years back was still owning it.
And every fund has the story.
Every fund, right?
Every fund has the story. Someone is 2, someone is 13. Everyone, the numbers are like that.
That is true. And I think mutual fund, AMFI publishes data in terms of holding periods of mutual funds. And I think 55-60% of investors don't hold even mutual funds for more than 6 months or 1 year, something like that. So we are trading in mutual funds as well. So rather than losing your shirt and money in stocks, I think as I mentioned, it's not a shame not to own stocks. If you're starting out, you're still learning, you should go with mutual funds. And if you find that there's a smart money manager out there doing the hard work of finding good stocks for you, in the sense your returns are decently well, they're beating inflation, I think there's no harm just sticking with mutual funds. So this is what I advise to all youngsters I meet or everyone in my household. Don't pick stocks, go with mutual funds.
Vishal, just, since you talk about people starting out, I want to just pick up that thread. And I want, so many people have started out in the last 2 years in equity markets, in mutual funds, in investing in general. It makes me very optimistic, by the way. So many people entering the capital market, sort of benefiting from wealth creation. I mean, you really see sort of financialization of savings happen. I want to ask you for advice in two contexts. One is to people starting out their investment journey on how to get started. And the second is, as someone who's been in the industry for 20 odd years, advice to people building a career in this industry.
Okay, so I think for people who are starting out as investors, my biggest advice first and foremost is to know yourself. Right? So knowing yourself, I think, is the most important thing that you can do. If you don't have that patience, right, to own business and stocks, and as you gradually realize as you move into markets, right, I think you should not be picking stocks and you should be trading very, very carefully. So knowing yourself, I think, is a very important advice. It comes with age and experience, but I think that is something, if someone understands early in their lives, it's very important. Finding appropriate and right role models really help, right? And I think if I were to just cite a statistic, India had around 5 crore Demat account holders till 2019, before COVID. And in the next 2 years, we add another 4 or 5 crores. I think it's almost doubled, right, in terms of Demat. Active Demat account holders will be very less compared to that, almost 1/3 of that. But still, we realize that a lot of young people are coming to the stock market, right? For them, choosing the right role model instead of people or celebrities who come on television and say it's so easy, it's not difficult, right? You can make money so easily. I think that is a wrong start to the investing career. So choosing the right role models, they may be Warren Buffett, Charlie Munger, or anyone else, right? In your personal life, any investor you know of, for example, anyone you know of, right, who has done really well over 20, 30 years, not 6 months or 1 year. I think choosing right role models and knowing yourself is a very important thing for new investors. I think the advice for people who are like middle-aged or people who have been investing and who want to get down into full-time investing, I advise them against getting into full-time investing. Investing, I understand, is not a full-time activity. Yeah. Right. Plus, if you're really doing it sensibly, and if you're not trading and you are like a long-term buy and hold kind of investor, it gets very lonely and depressing at times, right? Because you're just buying, you're researching, and you identify a stock and you just have to hold on. And it gets very painful and, of course, lonely as well, because you're sitting behind a computer or reading an annual report and all those kind of things happen. Unlike when you're working on a job, you're meeting people, you're talking to people, right? And the third thing is the income is not really steady like your job and like your business income. So I would rather see people working hard in their jobs and professional lives, whether business and everything, saving enough money, and then part-time applying those lessons that they have learned in terms of sensible investing to invest their money sensibly, not as a full-time. If you're not a professional investor or you don't want to manage other people's money, I think investing should not be a full-time activity. You rather focus on better things in life than looking at stocks and mutual funds and NAVs and stock price on a daily basis. So, yeah.
I'm so glad you said that, Vishal, because, a lot of people sort of write to me, and a lot of young people, it seems, are sort of, and maybe it's a bull market thing, they're sort of driven to the idea of sitting and picking stocks daily. And, you see these tweets saying, my income from my salary was this, but in 6 months I was picking stocks and this happened. And I always say that when you're young, the best asset you have is actually your talent. So pour that energy into your career rather than picking stocks. And this can be a part-time activity. And it's good to hear that from someone like you.
No, I think as I started writing about investing, right, almost 11 years back, 2011, and there were not many people who did that. I always thought, I wish there were more people writing about long-term investing, value investing, philosophy, and financial literacy, basically. It has happened. But I think a lot of that has happened on the wrong direction, where you see financial influencers and personalities on YouTube and Twitter, right, who are laying out a wrong kind of road for people or guiding them in a wrong way. So I think media has to, or social media has to, take a high amount of responsibility in terms of being irresponsible in terms of the kind of advice that has been shared with youngsters. And young minds are like minds who are willing to take adventures, right? We have attention spans which are less than 8 seconds, less than a goldfish. If you combine that, I was just checking the IQ data for world on a whole, right? Since the last 100 years, the average IQ has increased by around 30 points. So we are getting much smarter. We are much smarter than an average person in 1910. But despite smartness and despite intelligence, the holding periods for stocks and mutual funds has come down from around 8 years to 6 months.
Very
right. So where is intelligence going? I just worry about if this is going to go the same way, where the intelligence increases and we are getting even more like short-tempered and like having short attention spans. I see a bleak future for long-term investing, but I see a great future for long-term investors, because that is where you create a differentiating advantage over most people who are just buying and selling. Right. And if you can just own businesses sensibly across market cycles for a long period of time, I think you can do reasonably well.
Interesting. Since you talked about sort of the long term, I think, of course, I'm an eternal optimist on India, but I want your take on this. Of course, we just celebrated the 75th year of independence, and our Prime Minister talked about the 100th year of independence and a vision for what India could be like. So how do you see India at 100? How do you see India? How do you see the economy? How do you see equity markets at 100?
I think I am an optimist as well, and that's the reason I am in the markets. I'm investing and I'm teaching people how to behave well so that they don't lose out on their hard-earned savings and betting on the India growth story for the long term. And they have to stick with India growth story for the long term if you really want to win at the game of investing, to use that term, right? So I am very optimistic on India for the next 10, 15, 20 years. We will have our cycles. We will have our down periods and extreme down periods as well, like all things that move in cycles in a pendulum, right? Markets, Indian economy, despite going great guns, is going to go through cycles, and so will the fortunes of investors, right? What I don't agree with as far as the India growth story is concerned, I don't agree with the idea of decoupling. I think India is well connected with the global economy, right? We have an integral part of the supply chain of manufacturing and every industry which is out there. So I don't think so that we have or we will be decoupling. Whatever happens globally, I think in some way will have an effect on India, good and bad. So I think people should not bet based on the decoupling theory and willing to pay up any kind of prices for stocks and like stocks in India as well. But I am an eternal optimist on India as well. And I think if you just stay invested in good quality businesses which are going to do well with India doing well, I think you would be handsomely rewarded. Not every year, but on a CAGR basis over a long period of time, you should do really well.
It's hard to buy it. I'm not a believer in the decoupling story too, Vishal. I think, in fact, economy, COVID taught you, right? Economies in that sense and markets are getting more interlinked than less interlinked.
That is true. That is true.
In the time where we live in. So I'm not sure if I buy. Now, I want to sort of change tracks a little bit. Got this beautiful book, The Sketchbook of Wisdom. And what I like is that it's not just an investment book. It's a life book. It's a book with timeless ideas for a happy life. So I have a couple of questions. My first is, why do you believe life and investing are sort of interlinked in this way? It's again my own personal belief, but I want to share that with you. I want you to share that. And secondly, if I were to ask you your favorite takeaway from the book among the sort of 50 ideas, what would that be? I know it's really. Choose their favorite chapter is really hard.
No, great. So thanks for mentioning the Sketchbook of Wisdom. I think the idea of writing that book and actually publishing that book happened within like 6 to 8 month kind of period, the entire process. So I really cherish that period. And that was in the lockdown period, right? So people, when they look at bad periods and they remember them for the bad things which happened, right? I look at lockdown in terms of giving me some opportunity to think hard, reflect on my life as well, and come out with something that I think my kids would read or love read as they grow up in life. So when I look back at the Sketchbook of Wisdom, I think that is a book which I wrote for myself as a manual, as a constant reminder of being a good human being, and also for children who would want to read that. I think the reason I think life and investing are interlinked is that in both these spaces, whether living a good life or being a good investor, you should know what to avoid doing, and you should be doing the right things, right? Focusing on doing the right things. There's an idea of inversion which means that if you want to solve the most difficult questions, you should invert them. So rather than asking, how do I get rich in investing? You should be asking, how do I fail as an investor? And you stop doing those things. In the same way, I think a similar kind of question for life is, instead of asking, how can I be happy in life? You should be asking, how would I be miserable in life? And you stop doing those things. Right. So the idea of good behavior and avoiding bad behavior is true for investing. and it's true for life as well. And I think that is the way they are interlinked. And if you go and read the ideas of the best investors out there, whether Charlie Munger, Warren Buffett, Howard Marks, Daniel Kahneman, and so many good investors in India as well, they have taught about lessons or taught us lessons where you realize that it's all connected. It's all connected out there. There's no separation where you can say I can be a patient investor, but I'm not patient in life. You cannot be that way. You have to be patient in life, and only then you can be a patient investor. So that is how I relate life to investing, and that is the reason I wanted to write a book on life, on good life, including some chapters on how to deal with your money, because they're all interlinked, right? So that is the genesis of the Sketchbook of Wisdom. Difficult to pick out the best ideas out there, but I think if I were to still pull out a couple of ideas, I think one of them would be the chapter on equanimity, which simply means that you go through life, the good parts and bad periods of life, and like Rudyard Kipling said, you treat the two imposters of triumph and disaster as they are same, right? So you go through the good parts of life and bad parts of life as same, thinking that they are all going to pass. And that holds such a great relevance in investing, right? Markets go through up and down, but if you keep boarding that Rajdhani Express, right, even through slow speeds and fast speed, if you really want to reach Delhi, for example, as a destination, right, you have to be equanimous. You have to ignore the market noise. You have to ignore what speeds other investors are going at. So that is one thing which I think is the biggest idea for me. The second favorite of my topics is on the lesson which I've written on self-pity. Right, a lot of people they go through bad periods. Each one of us go through bad periods in life. If we keep indulging in self-pity, right, we are not going to move ahead. So there in that lesson, I talk about a story from Charlie Munger. So a lot of people know Charlie Munger as a rich billionaire and guy who's one of the wisest in investing and otherwise as well. But not many people know that around 25 years of age, Charlie Munger was divorced. He was broke. He lost his son to cancer. He lost one eye to a bad operation. Right. And he says that I could have ended up in self-pity, right? I would have been pitying my life and done nothing as well. Rather, I chose to look back, reconstruct my life and move forward. Right. So I think the idea of not pitying our past and not regretting our past, right, taking lessons from it and just moving forward, because every day is like a new life for you, right? Every time you wake up in the morning, it's like a new life for you. So that idea, I think, really resonates well with me. I think so. These are the two key ideas from the Sketchbook of Wisdom.
I think there's a great lessons in resilience from that Munger story. There's a beautiful lessons in picking up the pieces and sort of also in moving forward. I think there's a great lesson in life and investing. I mean, it's also not to hold back on your mistakes. I keep telling young investors, I think making mistakes doesn't mean you stop investing. So I think there is a great lesson there.
Vishal, just to interrupt, I think since we were talking before this conversation started about your book Limitless, right? Let me mention that idea of being limitless is getting over self-pity and understanding that you can grow out of those kind of situations in life, right? Go out of any kind of tough situations in life and be limitless. So yeah, I think that goes well with what you wrote as well. Thank you.
No, I want to ask you one last question before I move into the final segment. And I've interviewed lots of people on Connect, great minds. You've interviewed so many phenomenal people on the 1% show. And I'm sure it must be one of the most enriching things you do. I think having these conversations is probably one of the most, and I'm sure each guest teaches you a lot. What are the 2 or 3 most magical things you've learned from a particular guest? And is there any commonality you find among such a wide range of people that you've interviewed?
Well, I think, as you mentioned, I think one of the biggest beneficiaries of this initiative of the 1% show is me, myself, right? Not just in terms of having to spend those like 1 or 2 or 3 hours, in fact, with some of the wisest people I know of one-on-one conversation, right? Heart-to-heart conversation, but also in terms of the direct lessons which I can learn from their long life and long experience. Right. In terms of lessons, I've done like 23 sessions so far, and there have been probably 230 lessons which I could draw out from. Like everyone has shared so many lessons, including yourself. But I think the one of the best lessons which I learned from the show and which I can remember and relate to, I think, and multiple people talked about the same thing, right? I'll come to that. But William Green, in a recent episode, which I went on for like marathon 3 hours, he mentioned about the idea of playing games that you can win. right? So you choose the games that you can win at, and you just play those games again, not bothering about what the games others are playing, right? And in the meanwhile, you also need to accept your limitation. That's the reason you choose the games that you can win, and you play only those games, whatever the world is doing, right? So he gave an example of, despite meeting and talking and learning about investing for so many years, and he's a wonderful person, right? And he's written this amazing book called Richer, Wiser, Happier, which I advise everyone to read. He still does not invest his own money. He says, because I am not good at that game myself. I am not so rational as to invest my money. And that's the reason I've hired money managers and professionals who can do that work better. So you need to have that kind of humility to know that there are only few games in life that you can win, and you just play those games. So that is one thing. I think Manish Chokhani, which is the first episode I had this idea of Swadharma. Swadharma means living true to your nature, which I think is very well again connected with what William Green said, right? When you are true to your nature, only then you're going to play the games that you think you can win, rather than what the world wants you to, right? And I think you also, if I were to go into our conversation, you chose the words, or you use the words, choosing the battles that you want to fight, right? So you've chosen, and you gave examples from your own life in terms of the battles that you wanted to fight rather than what the society wanted you to fight, right? So they all related, and that's the best thing about talking to wonderful people, right? Especially those with experience of living a good life, that almost all ideas converge to a single key idea, that this is what it is, right? There are only like 10 commandments. There are only few ideas in Hinduism or any kind of philosophy. If we can imbibe them, and the kind of lessons that I've learned from these great people for the last 23 episodes, I think they all converge to that one idea, that this is what it is, and you have to play your own game, not worrying about what the others play. One final idea which I remember a lot and which I have applied to my life is the idea which I relearned from Guy Spear, who manages Aquamarine Capital in Zurich. And he has this idea of compounding goodwill. We all talk about power of compounding as far as money is concerned, but he mentioned that money is just a tip of the iceberg of the kind of wealth that we all possess, whether it's a relationship, whether it's a health, whether it's the kind of time that we have, and the kind of world we are living in. These are various forms of wealth, but we are only focused on compounding as far as money is concerned, right? If you can try and compound your personal goodwill by building up good relationships with people, by being kind to others, by saying thank you, by having gratefulness or gratitude to the kind of life you're living, I think that is the best compounding that you can achieve. And that's the most eternal and enduring compounding, or the benefit that you can achieve from this idea. So I think these are some of the lessons. Of course, there are many, but yeah, they are like top of my mind.
Yeah, it's interesting, Vishal, and this is not a book pitch, but my favorite line, incidentally, that I wrote in Limitless was also that self-confidence comes from finally realizing that you are unique, and then playing your own game. And when you play your game, you play like a champion. So I can't agree more on that. And it's interesting that so many minds come to that game. So Vishal, I am going to give you a touch of your own medicine from the 1% show, and end with a little rapid fire. I hope you will be rapid. I hope you'll have fire. And Coffee with Karan is quite a popular show, so I promise I will send you a coffee hamper, or I used to say it's a rum with Radhika hamper, but we're not at that point in the evening, and it's an investing show, so maybe I'll skip the rum part of the hamper. But here goes. So you talked about investment icons, a modern investment icon for you. Vishal, can you hear me?
Yeah, I can.
Oh, you're still thinking.
No, I'm waiting for the question. I didn't hear the last part of the question.
Okay, sorry. So an investment icon for you, a modern day investment icon for you.
Modern day investment icon, I think Warren Buffett. He's modern as well, so I will not leave him aside.
He's young as hell. So yeah. I've just had a baby, Vishal, you know that. But what would your investment advice for a young child be once he starts talking and walking and learning?
No, I think I would rather not give him any investment advice. I think just as you mentioned, find your own battles and be the kind of investor that suits your personality. I think nothing more than that. Money is just a tip of the iceberg, as I mentioned. I think focus on greater wealth in life, which is family. I think there's no better thing than family. So focus on family. That's my advice to your child, my child, any child.
What does financial freedom in one line mean to you?
It's the independence, the freedom to do things I want to do with people I want to do, where I want to do, and whenever I want to do.
Very nice. I love that. Okay, your take on some of the trends, quick take, influencers,
Avoid by far.
avoid by far. New age assets like cryptocurrency,
Avoid by far.
avoid by far. Okay. New age companies that are listing.
Avoid by very far.
Now, there's a common theme. And unicorns.
Be very careful.
Be very
There are great businesses, but be very careful of what you're getting into.
Okay.
Unicorns is just a valuation number. It's just based on valuation, not on the quality of business. So be very careful.
Many of the people listening, or some of the people listening on this call, are financial advisors who also look up to you. Your one-line advice for them.
Stay true to what you are and play the game in the benefit of the person on the other side of the table and not yourself only.
One thing that makes you optimistic about India and one thing that makes you not so optimistic about India.
I think my kids make me optimistic about India, right? The kind of people they are growing up into. Not optimistic about India. I'm not really sure about that, but I think we still have a lot of road to cover in terms of governance and personal morality, in terms of corruption and everything. So I think once we cross that thing, I think there's no looking back.
Okay. One thing that we can do as an industry, as a capital markets industry, to bring more women into this industry as investors.
Oh, I think you setting an example, Radhika. So I think just keep setting the example. I think that would attract more women to the industry. I don't really talk to, or even when I talk to men, right? I don't talk about in the sense that how can we get in more women to the industry, because nobody takes your words, right? It's entirely about setting an example, and I think you're doing that. So you're a better person to answer than I am.
Long way to go. Okay. The mutual fund industry is 40 lakh crores today. We just crossed 100 million demat accounts. If I were to ask you at India at 100, where do you think these two numbers would be?
Which one? The mutual fund industry at 40,000 crore rupees?
Both.
And the second number was?
Demat accounts.
Demat accounts. If I were to take a guess, I think probably will be around 25 crore demat accounts. Right. Yeah. And 40,000 crores, I think, should also triple. So,
40 lakh crore. Yeah. Where should we be?
40 lakh crore, I think, should also triple.
Triple from here.
Yeah.
So
Yeah.
120 lakh crore mutual fund.
Yeah. That's on the conservative side. I'm a conservative investor, so that's on the conservative side.
Okay. And then the last question, Vishal, if you were made finance minister for a day, what would be the one change you would want to bring?
I would just shun publicity. I'll just go and sleep. I think that's too big a task. So I would not want to comment on that. So
lovely. So thanks so much, Vishal. It was fantastic talking to you. As I expected, I think you were frank, you were fun, and there was a lot of depth and wisdom. So really appreciate you joining us today. And I hope this is not the last time that we'll see you on a version of Edelweiss Connect. Now that we know your special Edelweiss connection, yes, we will make sure we take serious advantage of it.
That's right. So the ball is in your court, Radhika. So thank you so much for this. And it's an honor talking to you. It's a pleasure talking to you. And I love the questions. It was fun. So thank you so much for everything.
Thanks, Vishal.
Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.